Well, the major writers are clue. It's Aftermath is volume 4 of the 4-volume International Monetary Quartet. So the first book was Currency Wars, came out in 2011. Then The Death of Money came out in 2014. If trend is 3.5, and you're running at 2, that gap between, say, 3.5 and 2, that's depressed growth. So yes, you have growth. You're not in a technical recession, but you're in a depression because you're not getting back to that trend. Well, the major writers are clue. It's Aftermath is volume 4 of a 4-volume International Monetary Quartet. So the first book was Currency Wars, came out in 2011. Then The Death of Money came out in 2014. Then The Road to Ruin came out in 2016. You can see I have these nice cheery titles. And then Aftermath comes out in 2019. The Aftermath title has kind of a double entendre. Yes, it's the aftermath of the 2008 global financial crisis. We're still living through it. The issues are not resolved. We'll have more crises sooner than later because it was sort of handed off to the central banks, but the central banks have not been able to get their balance sheets back to normal. They've not been able to get interest rates back to normal. So they're completely unprepared for the next crisis. My view is that the world has been in a depression since 2007 and will remain so for an indefinite period of time. And when you say that, people are, wait a second, we know the definition of a recession, the technical definition of a recession is 2 consecutive quarters of declining GDP, rising unemployment. There's a few other bells and whistles. There's a little bit of subjectivity to it. The National Bureau of Economic Research are the unofficial but widely followed referees on when you're in a recession and when you're not. Well, we're in the 9th year of an expansion. The expansion started in June 2009. Here we are in the summer of 2018, 9 years behind us in our 10th year. So wait a second, how could we be in a depression if we're in the 10th year of an expansion? The United States has had a lost decade from 2007 to now 2018. We're probably, if something doesn't change, either in terms of policy or a collapse, something gets worse. But absent that, we're going to remain in this kind of punk 2% growth as far as the eye can see. People say, oh, well, second quarter GDP, Atlanta Fed predicts, 4.5%. Yeah, but we've had 4 and 5% quarters in the last 9 years. They don't last. You get these spikes, you get a real good, 4% print, and then the next quarter is 2%, the one after that is 0.5 or maybe even a negative quarter. So a year and a half into the Trump administration, he's producing the same kind of growth as Obama. If trend is 3.5, and you're running at 2, that gap between, say, 3.5 and 2, that's depressed growth. So yes, you have growth. You're not in a technical recession, but you're in a depression because you're not getting back to that trend. And people say, well, 2%, 3%, it's 1 percentage point. Who cares? No, that gap is huge. And because of the compounding effect, think of it as a wedge. Here's the trend line. Here's the actual line. That wedge gets bigger. So we're 10 years out. We've left $5 trillion of potential growth on the table. That's the output gap or the growth gap, the difference between depressed growth and trend growth. That's how much wealth has been lost because of this depressed growth. By the way, that definition I gave, a sustained period of below trend growth, that's not my definition. John Maynard Keynes came up with that definition in the 1930s. It was good enough for him. It's good enough for me. I think it's accurate, but being objective, using the numbers I mentioned, we're in a depression. We're going to stay that way. The United States is Japan. Japan had the famous lost decade. Well, the lost decade was 20 years ago.
Depression is different. Economists, first of all, don't like the word depression because it's more subjective. It's not as quantitative. It involves a lot of almost psychological, behavioral variables, if you will. But depressions are real. They happen, and we're in one now. But economists just don't like to talk about it. They've kind of banned the D word, as I put it, from the vocabulary. So a lot of people assume that if a recession is 2 quarters or more of declining GDP, and a depression sounds worse, that must be 10 quarters of declining GDP, some really horrible economic outcome. And that's not the definition. You can actually have growth in a depression, but the point is it's depressed growth. So their monetary model was wrong because they don't take account of velocity. Their fiscal model was wrong because they ignore the fact that debt to GDP ratios are now in excess of 90%. The research shows that at that level, your Keynesian multiplier is less than 1, meaning if you borrow $1 and spend $1, you get less than $1 of GDP, which means your debt to GDP ratio goes up. People save more and spend less. So monetary policy will fail because of what's called velocity, or the turnover of money. I mean, just to be specific, the Federal Reserve, our U.S. central bank, has printed almost $4 trillion in the past year. This time last year, the Federal Reserve balance sheet was about $3.6 trillion, give or take. Today, it's about $7.5 trillion. So that's $4 trillion of new money printing. But the money printing doesn't matter. It does not stimulate. They call it stimulus, but it's not. It does not stimulate, and it does not cause inflation. So my real rate after taxes and inflation was -8. That's a low rate. But right now, real rates are about -0.4. So the nominal rate has to go all the way down to 0 and probably go negative, not because of Fed policy, but because of secondary market trading. If you buy a 10-year note from me and you pay me a premium over face value that's greater than the strip of coupons, your yield to maturity is going to be negative. So it doesn't require a Fed policy rate, a negative short-term overnight rate. It just requires a premium greater than the future value of the coupons. And that can happen easily, and it has happened in Germany and elsewhere. So as that happens, there'll be enormous capital gains on 10-year Treasury notes. I also recommend cash. It has no yield, but it has, first of all, it could be your best performing asset in deflation because the real value of cash goes up. And it gives you optionality. You can be the one who sits back and, gold's going up, well, I'll buy some more gold. Or, Jim Rickards is wrong, the economy's fine, well, now I'll buy some more equities. The point is, you have optionality and flexibility, and that's very valuable in uncertain times. Real GDP potential and no desire for inflation. If you want P to be 1, Q to be 3.5%, and you hold velocity constant, you just dial the money supply up or down, and you get maximum real growth with no inflation. That was nirvana. The only problem with that is that velocity is not constant. It was a wrong assumption. So I remind people, $7 trillion times 0 is 0. If you don't have velocity, you don't have an economy. So the question is, how do you get velocity to change? That's psychological. It's based on expectations. You have to get expectations to change. So central banks think that they can do it by holding interest rates at 0. But what message is the central bank sending when interest rates are 0? They're saying that they're worried about deflation. Well, if you're worried about deflation, why should I spend money? I'll just hold on to my money and wait till prices drop and go buy things more cheaply in the future. Or in fact, the real value of cash increases in deflation, so I'll increase my allocation to cash. I'll increase my savings.
Its aftermath is volume 4 of a 4-volume International Monetary Quartet.
My view is that the world has been in a depression since 2007. So my real rate after taxes and inflation was -8. That's a low rate. That's psychological. It's based on expectations. You have to get expectations to change.